Hello, Dr. Shiller. Thank you for accepting our invitation for this interview. As you recall, our last gathering at Montage, Beverly Hills, turned out to be such a success for the Persian community, especially in California. Our most affluent and successful group have become a fan of you, Doctor, and followed your work ever since.
Oh, that's nice to hear.
Given the circumstances, we appreciate you joining us. Dear listeners, as you know, Dr. Robert Shiller has a massive influence on the financial world. In 2013, he was awarded the Nobel Prize of Economic Science. He is both a professor of economics and professor of finances at Yale University. Dr. Shiller has written many books such as Market Volatility, Micro Markets, The New Financial Order, Finance and Good Society, and Irrational Exuberance. He has not stopped there. Dr. Shiller continued to serve as Vice President of the American Economic Association and President of the Eastern Economic Association. He was elected President of the American Economic Association in 2013. Well, Dr. Shiller, in Persian community, you have huge followers. They are thrilled with your work, and it's such a pleasure to have you with us today. And welcome to our program, Doctor.
It's my pleasure, too.
We've been blessed with the information that you have passed on to not only to American society but to the Persian community. Having you has been really great because your insight on the various topics, it's really enlightening. That being said, Doctor, if you're ready, why don't we go through the first question?
Okay.
You know, Persians in all over the world, particularly in California and United States, they have huge asset in real estate. And you managing the Case-Shiller Index and knowing basically, I will say, more than anybody in real estate details, what is your forecast of residential and commercial real estate in the United States?
Well, this is an exceptionally uncertain time because of the coronavirus. And I would say also in the United States, we're talking about the election and the conflict that divides. It's a strongly contested election. So these things all add uncertainty to the mix. We haven't really experienced just this situation ever before. I'm worried that the coronavirus will dampen enthusiasm for urban properties, both commercial and residential. People don't want to live in. They may not. We'll see how it works out. May not want to live in the center city. Also, the movement toward the working from home encourages people to move out to the suburbs or even further. And the attractions of big city living have diminished somewhat. If you are worried about eating out and going to the theater and that sort of thing because of the COVID-19. This will all be over at some day, but in the meantime, it may not bode well for real estate prices.
Fantastic. You know, there's always one question that comes out, and me being a financial advisor, they always ask me, should I buy real estate? Should I hold on? Should I sell? Should I take equity out? And they're referring to commercial and real estate. Would you have any insight on that?
Well, it depends on your situation. Especially with residential real estate, do you want a house? You might feel mobile. You might think, I don't want to be tied down to a certain region because maybe I'll find a job opportunity somewhere else that I prefer. Or you may have a family and you may appreciate the kind of living that a stable community somewhere offers. But if you're just looking at real estate as a pure investment, then you have to think like a business person. You have to think, how can I rent it out? How can I, do I really need this property? Because historically, home prices have not risen anywhere like the stock market. They go through booms, and we've been through one recently, but they tend to be followed by corrections. So it's not the great investment that, as a pure investment, that people think it is.
Yeah, that's true. Actually, by the time you add the expenses and what it takes to maintain, actually, you're absolutely right. Doctor, let's say I want to buy a house. I don't own a house. And this question comes up a lot. Should we buy now or just wait to see where we're heading economically?
That's a good question. So our S&P CoreLogic Case-Shiller home price indices, which I developed with others, are still going up. And they're going up faster than inflation still. But it has been slowing down. And the real estate market is different from the stock market. It's much less choppy, and it's much more inertial. It goes in the same direction. So it's been weakening in its strength of appreciation for several years now. So I worry that it might actually start to fall, as it has in some cities, like New York City. It fell in our latest monthly data. It has to do with the story. We are still worried about New York because it's business. It's an entertainment center, but it can't function as that right now, not well, because of the virus. And so it's not the best time to buy. But if you really need a house, if it's something you dream of, maybe you don't want to put your life on hold, and you could go ahead and purchase.
I see. Doctor, it's strange, given the fact that we have, 29 or 30 million unemployed people. Businesses are closing down. We have the COVID-19 dealing. But the prices, at least in California, continue to go higher. Is there any logic to this?
Yeah, it's the same in all three major asset classes: housing, bonds, and the stock market. I mean, they've all been going higher over COVID-19, and that seems kind of puzzling. But I think the markets are more psychological than the usual economic analysis would suggest. And so there's something going on at this point. Fear of the future can trigger buying because people want to be into a good situation, and they're worried about their future. That sounds odd, but it can be that way. In the United States, the whole experience with Donald Trump is very much affecting our thinking, although it affects two different groups of people in opposite ways at many times. But I think it also it may encourage a sort of patriotic optimism and suggested behavior by our president of living high. You don't want to. You have to show off your high status by living nicely.
I see. The question that always comes out, Doctor, is that what do you recommend to protect assets, retirement accounts, and investments in a stock market?
Well, of course, the first thing that comes to mind, I teach finance. You could take my course. I have a free online Coursera course called Financial Markets. But the first thing, as a teacher of finance, I would say diversification always helps. You invest in many different things, different asset classes around the world, and then you're not so subject to big drops. The other thing is value investing, although it looks in many cases not so good lately. That makes it all the more urgent to do it now. And that means buying things that are overlooked or cheap, stocks or particularly. And the third thing is not to worry too much about, and not think that this has to be an obligation of your work for a long time. You can't time the market perfectly. and you don't want to go in and out by changing your mind too often. It'll make you sick with worry. So I think it is a rather worrisome time now for all these markets. They could go down, but you want to be diversified and avoiding the extremes, and you want to be buying less expensive securities. So you don't have to avoid the United States. You just have to invest in things that are not as expensive in the United States, and go to sectors that are less expensive.
That's true. Doctor, you implied to the fact that a lot of people use their emotion to get in and out the market. So you disagree with people keep selling, buying, trying to market timing? Because a lot of people do that. I don't know if that ever works.
Well, I think it's not hope. It is for people who do it well and right, and not every day, unless you have an algorithm that is tested. I think that for the average person, it's not to trade too often is a mistake. You incur bid-ask spreads, you incur transactions costs. It's overdone by some people, but I do think that intelligent people who work at it can outperform the market somewhat. Okay, it's not going to be perfect. I'm not as against market timing as some people are.
Doctor, in continuation about the volatility in the market and trying to market time, especially sensitivity of the retirement accounts, because of the taxations on the retirement account, all that 401k doesn't belong to everybody because a part of that belongs to IRS. So when people get in and out the market, obviously market timing never works, as you implied to it. However, some people saying that I'm tired of what's going on, I just want to cash out, sit on the side, and see where we're heading. Does that strategy ever work? Because I hear that a lot with my clients, and a lot of people call me on the radio, and they ask that question. I was wondering if you have any insight on that.
Well, cashing out entirely is an extreme move. I would think that not that many people actually do that. Some people do, I know, but I'm not advocating going out completely. There's always some investments that are stronger than the market overall, and you have to, if you are going to consider cashing out entirely, you have to focus on your own psychology and making sure that you're not being influenced by short-run currents. I'll tell you, I do questionnaire surveys of investors, and I ask them what is the probability of a stock market crash in the next 6 months? And I find that the investors in around 2009 had a very high probability of doing that. So they were very worried about a crash right when it was the perfect time to buy. So they got it backwards. So I don't know how many people lost a lot of money by cashing out of the market, but I suspect some did at that time. It's just unfortunate. We just can't accurately predict the market. We can somewhat predict the market. And if you want to work at it, you can find times to get out of it if you're smart, okay? And you've got to be diligent. For most people, it's too much.
That's true, because they're busy doing their work and they really don't know what's going on with the market, and there's so many news that affects the market on a daily basis. Overall, doctor, for average family that they are looking for long-term stock markets, regardless of the situation, would you advise them just continuously buying certain indices and portfolios and just not looking at it on a daily basis? Or do you believe in some sort of, like a daily management on the especially retirement account or the portfolios that they own? Because I always talk about long-term, and as you imply that the fact that market in long-term has surpassed even real estate. But on the short-term, people get kind of like sidetracked from that. I was just wondering that in the long-term, Do you believe in continuously investing in the markets and basically not getting affected by the daily news?
It is true the daily news makes an awfully big thing of the stock market. That really started in 1929 because the stock market crashed, as you may have heard, in October of 1929, and we had a Great Depression for the next 10 years. So that imbued the stock market with great significance, and it's talked about probably too much ever since. But on the other hand, I think that people who studied the market in 1929, a lot of them had gotten out. They had some regrets because they missed. In the last 5 months, I think the market went up something like 30 or 40% in 1929. So it was gaining so fast that people were having doubts. Some of them went back in thinking, I was just wrong to do this. But 1929 was a bad year to be invested in the markets, and I think a smart person might have gained somewhat. It's just so hard to know exactly when to get in and out. And it's kind of a nightmare situation. I think a lot of people could just do what you say and just buy and hold. On the other hand, we do have value products, and we do have investments that are a little bit better. You don't have to just hold the whole market. I know this is a bad time overall for value investing, but I think it makes sense in the long run.
Very good. Thank you so much, Doctor. Dr. Shiller, my next question is, Shiller-Barclay's CAPE Index has surpassed the return of S&P 500 for many, many years. Dr. Shiller, what is your secret to its success?
Well, first of all, it's still risky. There's a little bit of luck in that, but in the long run, I think it pays off. And the secret, I suppose, is taking account of the irrationalities in the market, thinking that you want to pull out of the faddish stocks and invest in less glamorous maybe, but more, you have to buy low and sell high. And so there are products, including our product at Barclays, that allow people to let the in and out handled by experts. And so I have published papers over, some of them go back over 30 years, methods of predicting the stock market. It turns out it's not completely unpredictable. And I have a CAPE ratio, or cyclically adjusted price-earnings ratio, that is central to the Barclays products. It's a way of indicating which sectors are too high or which sectors are priced well. You know, people make a mistake of thinking, if it's a good company, I will buy it. But you have to look at, what's the price? It's a good company, but maybe the price has gotten too high, so you want to stay away. You might go into a company that isn't doing that well in the stock market, but will again.
Doctor, I want to congratulate you. I don't know how you have time to basically to teach, do all the research, public speeches, and also managing funds. I just want to thank you because you have made my life so much easier because some of the investments that I have put in the CAPE Shiller Index, I didn't basically have to do much. I just had to follow your success, and you have made my life easier. I want to thank you, Doctor, and they've been getting double digits on it. Anyways, but that being said, Doctor, you were referring to CAPE ratio, which is a number, it looks like. Do you want to elaborate on that a little bit? What are those numbers? Does it indicate anything? Do we have a high number, or do we have low numbers?
Yes. So accountants produce earnings quarterly, typically, and that earnings is a measure of how well the company is doing at a point in time. The price ratio is a ratio of the stock price divided by earnings. Usually they do the last year's earning, or some do forward earnings, but only 1 year. So if its price is high relative to their earnings, that's a sign that they're maybe overpriced. Not necessarily. It's not always going to work, but it's a sign that on average they're not going to do as well in terms of their price. But the 1 year earnings is not long enough. Why not take a longer average of earnings? So the CAPE ratio uses a 10-year average of earnings. And in my work with John Campbell at Harvard, we showed that, in fact, that does somewhat forecast, not in the short run so well, but in the longer run, over years, it does forecast returns. So you want to stay away from the high cyclically adjusted price earnings or high CAPE stocks in favor of those that are lower. There's always different strategies, but this is a basic strategy that has held up. With my data, it has worked all the way back to the late 19th century to do this CAPE investing.
Doctor, do you also follow a CAPE ratio in your real estate portfolio as well? When that reaches a certain number, it's alarming?
Yes, in real estate as well. And if you had done that in the past, now for REITs you have earnings data or free cash flow data that you can use as a denominator, and you can do something like CAPE. It may not be so important for commercial real estate to average over 10 years because their income tends to be more steady because they have leases that go for a long time. But with single-family homes, we don't have any products involving direct investment in single-family homes. So you have to do it yourself. The single-family home market is more of an amateur market, and there are more mispricings. But you have to judge them for yourself. Homes are all different. No two are identical. And you have to get a sense of, is this neighborhood going up or down, or are prices too high in this neighborhood? Are people overspending on housing? And because they go through waves as well. So right now, the waves in the sense that they show momentum. So right now, as I have observed with the S&P CoreLogic Case Shiller data that we produce, the momentum is slowing down, and it could come into declines. It doesn't crash quite like the stock market, but it could be a somewhat bad time to buy single-family homes in general.
Doctor, given the fact that technology is doing really good this year, but not so much S&P 500 and Dow Jones, are you in favor of technology stocks in general?
Yeah, well, we've been including technology stocks in our CAPE products in recent years because even though they have a high information technology sector has a high CAPE, it's been high for a long time. And so we have what we call relative CAPE, which is CAPE compared to its long average. And so that suggests that over the years we have benefited from, in our products, in our CAPE product, we have benefited from information technology as part of our portfolio. Also, it's a singular American thing. America has the highest fraction of our stock market devoted to information technology. So it feels good here in America. But things don't go on forever, and there still is always going to be risks, even in information technology.
Thank you so much, Doctor. Appreciate the insight on this. Dr. Shiller, my next question is, are there untapped opportunities in overseas market versus United States? Will international markets be stronger in the future than U.S.?
Well, yes, that is an important question. The first thing I would say is it's a good idea in general to invest in international markets as a diversification. And, you know, America has only 4% of the world population. We dominate very much in stock market value, and it's a great success. But other countries are coming up, too. And I think that the developing world has done a very interesting investment. And also the advanced, for example, Europe. They're all cheaper in terms of CAPE than the United States. The United States is the most expensive stock market in the world. That's partly because it has a big technology component. Some people think that technology is going to be even stronger than ever now because of the lessons we've learned from COVID. Like, for example, you don't have to drive into work anymore. You can work at home using advanced technology like Zoom or WebEx. But I think you don't want to get carried away too much with those stories. There's a lot of smart people all over the world, and they're looking at the success America has had, and they're successfully moving toward new products. Just look at TikTok, for example, which is a fun website or app that was produced in China. They've got something like over 100 million subscribers in the United States. So that kind of thing never used to happen, but now it's happening. So I think that diversification around the world is an important step. But you don't want to go all in. If you took the country with the lowest CAPE ratio recently of major countries, that's Russia. And the CAPE ratio is well below 10, very low. So you might want to put something in Russia, but I wouldn't put my whole portfolio in it. That would be too risky.
Doctor, do you think we're losing the edge a little bit as far as stock market to the rest of the world, or you see still the U.S. going really strong for the next many, many years?
Well, I think it will probably go strong, but not as strong maybe. It has a great entrepreneurial tradition, and right now it's being free market status and a sense of trust in each other is eroded somewhat. And I think the stock market is vulnerable right now. It is something of a puzzle why people are so willing to pay high prices for stocks. But I think you can see it. They feel that they have no alternative. Bonds are very expensive, and real estate is expensive. So people are living with these prices. But that doesn't mean they can't correct down. This is also a time for people to do human capital investing. Invest in an education for yourself or your children, because that's an entirely different marketplace. Human capital is knowledge and skills, and this is an important time to pick up some of those things.
Doctor, I hear some countries, small regions, they are doing non-U.S. dollar trades. Are you concerned about the future of dollar as far as being the currency of the world, or how do you see the future of the dollar?
Well, again, I have to say I don't know for sure. But the past reliance on the dollar reflected trust in the U.S. as a peaceful capitalist nation, and that trust is still there. It also helps explain our high government bond prices. But it can be eroded. And I think that all over the world they're talking about the political polarization in the United States right now. And in the upcoming election as a possibly fraudulent election. And that might disturb the market. And I wouldn't go too heavily into the U.S. stock market at the present time. I think some investments, especially in low-priced sectors, is advisable. Just not to just think that it's a foregone conclusion that it's going to keep trending up as it has for over 10 years now.
My question is, where do you see economy United States in the next 5 years? Because China, kind of troubling the world a little bit. Where do you see us going in the next 5 years?
This is an exceptionally difficult time to make this forecast. COVID-19 should be under control, let's hope, in 5 years. It may be pushed back to being something like influenza in 5 years. The Trump presidency will, I think, be over because he's limited to 2 terms. There'll still be polarization. I'm sure the polarization won't go away. And I think that it will reduce economic growth somewhat and will reduce the animal spirits that lead to economic growth. So I'm thinking it'll be okay. Well, the home prices will be maybe a little lower than they are now in real terms, but it probably won't be a disaster. I'm giving you my middle forecast. It's neither optimistic nor pessimistic. There could be bigger events, but maybe we don't want to overemphasize that.
Well, thank you so much, Dr. Shiller. It was a pleasure talking to you. On behalf of my listeners, economics and family, myself, we truly appreciate and look forward for many, many other opportunities to have more conversations with you. Have a wonderful day, Doctor.
Thank you. It was a pleasure.